what's happened in the last few years in the American stock market, and actually foreign stock markets too, is that some traders have a speed advantage on everybody else. And they're willing to pay vast sums of money for very tiny increments of speed. And the speed with which they can get a signal from the Chicago Futures Exchange to the stocks exchanges in New Jersey is important to them. Up until 2007, 2008, the fastest line that was available was like a Verizon wireless line. And the cable, the fiber optic cable, went like this from Chicago to New Jersey. A trader on the Chicago Exchange who was sensitive to the fact that people would pay a fortune for just a tiny bit of speed realized that if he laid a straight line from Chicago to New Jersey, he could do it 4 milliseconds faster. And he did it in complete stealth, dug a tunnel from the Chicago Mercantile Exchange in Chicago to building outside the NASDAQ Stock Exchange and laid this straight fiber. And without knowing exactly what the market was or anything. And goes into high-frequency traders and basically says, if you don't have this, you're out of business. And the fact that someone could dig a tunnel, I mean, it was a project involving thousands of men. I mean, it cost $300, $400 million, ran through states, public right-of-ways in states, without anybody knowing what it was for.
And to improve speed by
4 milliseconds.
4 milliseconds.
3 or 4 milliseconds.
Right. Which is about the time it takes for the Chicago S&P's futures to be sent to New York. That is, so if the S&P goes up.
So yeah, the point of the line, from the point of view of the speed traders, is that the market movements, whether it's going up or down by a lot, register first in Chicago in the Futures Exchange. So they're supposedly making markets in 4,000 individual stocks in New Jersey. If they can get the signal first, the market's going down, they can get out, or they can even sell to other people. So it gives them advance news on price movements in the market.
So let me take you back, though, step back, and if you look at what you're describing, it seems to me what you're talking about is more technology, more information, price information, and more competition. And if you look over the last 20 years, haven't those three forces powerfully helped consumers and finance? That is to say, if you go back 20 or 30 years ago, it was much more expensive to buy and sell stocks. There were many more intermediaries, fancy brokers who you had to go to, and that all these forces have been powerful kind of democratizing forces for the consumer. Right?
Absolutely true. So that's absolutely true. The information technology, what has happened, is essentially put certain businesses on Wall Street out of business. It made certain functions that Wall Street used to serve, bringing buyers and sellers together, a human being bringing them together, unnecessary. The problem is that though a lot of the gains of the technology have been shared with the consumer, in this case the investor, and it's true that it's cheaper now to trade stocks than ever before, unnecessary rents have been captured by Wall Street. They didn't deliver all the gains. They have created a role for itself, for Wall Street, to sit between buyers and sellers completely unnecessarily and tax, essentially levy a tax on the investor. So it's as if, what's it like? So it's sort of like 20 years ago when I lived in London and I had to make a call to my parents in New Orleans. I'd pay $3 a minute. And if I live there now, it was, what is it, pennies a minute, right? It's as if it's as if the technologist who arranged that gave me most of the gains but charged me 20 cents a minute now instead. Now, I feel great. I can make my call for 20 cents a minute instead of $3 a minute. That's not the right comparison. It should be even cheaper. As cheap as it's gotten, it should be cheaper and more frictionless, and there should be less of a role for Wall Street in the middle of stock market transactions than there is.
Now, the Wall Street Journal, in an editorial, says the reason you have these complexities that you described, that you just called the kind of intermediaries where Wall Street has been able to put itself in the middle of transactions between consumers and stocks, is because of regulations, because there are a whole bunch of regulations that require a lot of this to happen. And that, in other words, if you were looking for a culprit.
They enable it. No, I think if you ask like who the culprit is, I don't think it's an interesting story because it isn't a conspiracy that was cooked up in advance. It looks like one in retrospect, but it wasn't. nobody knew the consequences of regulation that was passed in basically 2007. And it isn't just high-frequency traders. It's not that they aren't. I mean, they aren't really. They're not the villain in this in any way, really. They're taking advantage of a system that's broken.
What do you think of the characters you met in this? I mean, you've spent some time on Wall Street. You've met people like this, but a lot of the people seem like they're really kind of scientists of a kind. They're, mathematicians, engineers.
So this is what's happening on Wall Street. It's happening in every market, and the stock market, in a way, has gotten there first. Technology is supplanting traders. I mean, the technologists and the traders are merging. So there used to be, in the days when I worked there, the people who handled the computers were like IT geeks in the basement, and nobody thought that their status was low. One of the reasons I think the high-frequency trading industry has grown up outside of the big banks is that banks have trouble giving status to the technologists, and this is all about technologists. It's all about the software.
So I guess, my sort of conclusion from this, the part that I have a little bit of difficulty with is understanding, it seems to me, again, maybe as somebody who grew up outside the United States, that the great thing about American markets is that they're open, they're transparent, they're fast, they're well-regulated. And that the faster they've gotten, the more technology, the more transparency, the more competition has been great for consumers, for people like me who have, it feels like you're almost saying like that stuff is bad.
No, not saying that at all. There's a distinction that needs to be made, and it's between computerized trading and computerized scalping. And the problem is that when technology hit Wall Street figured out ways to use it for its purposes that were not in the interest of investors. A lot of what happened was very good. What we need, in a way, is I mean, the computerization is fantastic. The technology is a force for good. We just need to remove Wall Street from the process. I mean, I think the technology is sort of telling us you don't need these services that they're trying to provide you. You don't need all this trading, this unnecessary intermediation. Goldman Sachs has come out and said that the system, as it's structured, the problem with it is not just that people are getting scalped. That they are, but that's not the big problem. The big problem is that the system that generates the scalping is so complicated that it is unstable. And their worry is that the system is, the flash crashes and NASDAQ outages and all the technology failures we've seen in the markets are a result of an overly complicated system. And the complexity is there by design. It's there to disguise the scalping.